is our first event of this kind, and I'm extremely excited to have Mike Rothman of Cornerstone Analytics here for our inaugural client appreciation event for the Ninepoint Energy Fund and Ninepoint Energy Income Fund. The goal is to arm you with the same quality of information that we get. Mike has been, God, I've known Mike for many, many years. His work was pivotal in allowing me steer through what's been the worst bear market in history to become what we think is going to be the most exciting bull market in history. What I think you're going to hear today is some very differentiated views on the energy space. So much of my job is trying to shut out the noise and focus on what matters. Like today, Shanghai lockdowns, et cetera, oil's down $4. Is that noise, or is that something that we need to pay attention to in the short to medium term? And it's Mike's work that truly allows me to do that. And so I'm really excited. Mike's going to talk for about 10 to 15 minutes. Then we're going to have a 10 to 15 minute chat. We want this to keep this punchy, no holds barred, a lively conversation. Mike's both entertaining and educational, and so I'm really excited to have him aboard. So Mike, I'll turn it over to you.
Thanks very much. I am going to share my screen, and we're going to go through a fair amount of data, but try to make it palatable to you. So this cartoon seems kind of goofy to start a presentation like this with, but the fact is, this is the landscape we're in. There's a lot of virtue signaling. We're seeing it with the green energy initiatives, and you can be right and still somehow come in second or third place because somebody's indignation takes a higher ranking. We care about the oil balance, the actual landscape we have to live in, and I'm going to start with this graphic, which Eric certainly will be familiar with, but most people have not seen. We're coming off of what has been the single largest draw on inventories in the history of the oil markets. We care about inventories for a very significant reason. I'm going to actually share that with you, but the problem is not that we had a drawdown that actually matched what we were looking for. The problem is the consensus was looking for inventories to build last year, and the inventory build was pushed forward to this year. So our view is very different than what you hear probably from most things that you read, whether the casual press or even other brokerage type houses. But the fact is, we care ultimately about what happens to the oil balance. Now, if you say why, this is the real answer. There's a very strong inverse relationship between inventories and oil prices. Ultimately, all supply and demand factors intersect at storage, which is why you have this inverse correlation. And we can actually model what oil prices should be based on inventories. And the current fair value for crude is a little over $113 a barrel. That's plus or minus $2 if you're really trying to nail down a figure. But we should be north of $110 a barrel, and we're trading about, $12 or $13 below that. So we are below fair value. Question is, should we be below fair value? And then really, what's the outlook? Where are we going from here? And what should we be worried about? So, sorry, I'm going to advance this slide. So if we back up and we think about our medium-term forecast, we have been very bullish about the medium term. The outlook boiled down to two real key vectors. One is that we fully expected coming out of COVID that demand would normalize and then grow globally at about half of the rate of GDP. That was a forecast. People have been hearing this for a year and a half. No change, nothing to make me feel we have to make a change. However, we did not expect to see a commensurate rebound in non-OPEC supply. And this makes our view very, very different, in addition to the fact that we expect demand to resume its normal secular pattern. This idea of non-OPEC supply growth likely disappointing market analysts and watchers is a pretty key issue. We're going to spend a little bit of time on a couple of the key points here. So the first thing we're going to talk about is demand and this issue of missing oil. And I know for this audience, this is perhaps overkill, but structurally, there is a problem with data for the emerging market economies, what we call the non-OECD countries. Now, if you think that this is going to get into some boring, sappy discussion, it's not for a couple of reasons, but this is really quite important. Most people, most Wall Street firms use just the supply-demand model that's published by the International Energy Agency. They do not do what's called a reconciled oil balance. Missing oil has to do with demand being underestimated or undercounted in the emerging market economies. Now, the reason that is so critical is that almost 100% of all the oil demand growth you've seen in the last 20 years is from the emerging market economies. But when the International Energy Agency was formed in 1974, their mandate was to collect and disseminate member country data. So the emerging markets have kind of been ignored, and there really hasn't been this build out of necessary data infrastructure. Now, a couple of months ago, the IEA made the single largest set of upward revisions in demand ever. I'm talking about going back to 1974 when they formed. It's something we have been writing about for 7 years. And yes, we were vindicated when this happened, but they only partially addressed the gap. If you look at the left, it's the tally of what's called missing oil, which is this demand underestimation. The number did not go to zero. The number currently is a little over 600 million barrels, which is quite a bit of oil. And it's because the IEA only made the revisions that were needed in 2014, 15, 16, and 17. They have not made all of the upward demand revisions from 2018 forward. And it's a problem because it means most people are still thinking that demand is lower than it really is. So when it comes to supply and this idea that we were going to get a big rebound in non-OPEC supply, we're on the other side of that. The oil industry has seen capex, capital expenditures for the oil production business cut pretty dramatically since the 2014 high water mark. It's down to about $2.2 trillion. I'll run an estimate sometime probably in the next month or so for the 2022 set of numbers. But this is an issue because you cannot cut back on the projects that you need to replace production from existing wells. And it's going to be compounded. The effect of this is going to be compounded by what we think is the Twilight of Shale. Now, the analysis on the right was something we were publishing in the second half of 2019, and it was not greeted with open arms at the time because it was considered almost heretical. Most people thought that U.S. shale oil production would just keep growing and growing and growing and growing. And what was happening is it was growing, but at a slower and slower and slower rate, which gets to the very nature of shale. It's a short life resource. And almost everybody was singularly focused on shale because for the last 10 years, it was essentially accounting for almost 100% of all your non-OPEC supply growth. That's a problem when you consider that in about half of that time, oil prices were over $100 a barrel, and you still couldn't really lever up production from the rest of non-OPEC. So with the U.S. story changing, it kind of fits into this medium-term outlook of non-OPEC supply growth likely to be a challenge. So OPEC capacity is something we started really focusing on in our work, I would say November of 2020. And why we're going all the way back to then is when we were looking at the next sort of 2 years, what we saw happening was this prospect for a record large inventory draw, which happened, demand rebounding as the effects of lockdowns, isolating behaviors from COVID dissipated, and then OPEC restraining its output. But if you looked sort of in the back half of 2022, we were facing a situation where it looked like OPEC's production capacity was going to become exhausted. Now, this is all in our research. Our clients are very familiar with it. It is not a mainstream view. It is certainly not the consensus view. But if you look at the analysis on your right, that is the production miss OPEC has had every month since the summer of 2020. This is OPEC production for the 10 countries in the deal versus quota. They've been below quota. Now, I started going to OPEC meetings 36 years ago. Meetings used to last weeks at a time, and the problem was there was so much spare production capacity that they had a hard time controlling it. This is the other side of that situation. And if you look at the right, even though in our work we've talked about Angola, we've talked about Nigeria, but 8 of the 10 countries were producing under quota. Now, of that list, Saudi Arabia and the United Arab Emirates do have spare capacity, but the rest of the group looks like it's challenged. We think this becomes a significant market feature later in the year. So when we talk about security of supply, this graphic, which we updated just about a week and a half ago because there were 2 attacks in Saudi Arabia on the Red Sea, this is something most people just assume is a given, meaning Saudi supply is perfectly secure, shouldn't have to worry about it, et cetera, et cetera. And that is really no longer a safe assumption. Now, we don't highlight it in particular on this graphic, but if you look at the very center and to the right, you'll see the word ABQAIQ, A-B-Q-A-I-Q. ABQAIQ is the single largest oil processing center in the world. It moves about 7.5 million barrels a day of crude through it, and it was attacked by drones in, I want to say it was the fall of 2019, I think September 14, 2019. That, in our opinion, was like a black swan event. It was theoretically supposed to never be able to happen. And we have had attacks on pipelines, refineries, shipping centers, et cetera, et cetera. Now, if this was priced into the market, it wouldn't be that interesting. But the fact is, none of this is priced into the market. And between this, what you have going on in Libya, you have a civil war in Iraq, you have a Christian-Muslim war in Nigeria, and of course, Venezuela is just deteriorating in front of your eyes. The concern here we have is that the supply situation is a lot more challenged than people are willing to admit to. So now we're facing another uncertainty, which is Russia. When they invaded Ukraine, the chat was some countries self-imposed embargoes. There are sanctions like the U.S. sanctions on importing any oil from Russia. Most countries have not done anything to limit Russian flows because Russia is the second largest oil exporter in the world, second after Saudi Arabia. Its volumes are irreplaceable. So back in August of 1990, August 2nd, Iraq invades Kuwait. And overnight, the market lost 4.2 million barrels of combined exports. That was made up for by the rest of OPEC within 3 weeks. If we lose 3 million barrels a day of Russian supply, it can't be made up from current spare capacity. That's a problem. The issue we have about this, and we're not going to jump on these suggestions that there's going to be a 3 or plus million barrel day loss. We don't know yet. We're waiting on the data. But the IEA put out an estimate about a month and a half ago saying we're going to lose 3 million barrels of Russian production starting in April. We don't know if it's a good number or not. There have been signs that clearly something has happened to Russian flows, but there's no way for us to quantify it. If we look at what that means, one thing is the large consuming countries releasing a record volume of emergency oil stocks. Between the U.S., which is the bulk of the oil that's going to be sold out of emergency inventories, and the rest of the OECD countries, you're talking about 322 million barrels sold from these emergency stocks. So you think it's a lot of oil, and it is a lot of oil. But the problem is if you're talking about losing Russian supply and you go with the IEA figure of 3 million barrels a day in the 2Q to 4Q period, you're losing over 800 million barrels just of that crude. This assumes nothing else happens, meaning the indicated output cuts coming for Kazakhstan are even allowed for. That gap that you see on the screen is 500 million barrels. That is massively problematic for the oil balance. Every 50 million barrels that inventories changes the price of oil by about $7. So do the math. That's, 7 times 10. It's an average increase of $70 a barrel. I mean, this is not what the market is worried about. In our opinion, I don't think many people are even thinking about it. And frankly, we're not saying it's going to happen because we really just don't know how much Russian and Kazakhstani oil we're going to lose. But it represents a major issue because of the potential impact on inventories. So in terms of how the world looks right now, and I talked about missing oil before, if you look on the left, this is the inventory change for the North America and the Pacific regions. These two areas account for roughly 70% of global inventories. And our estimate has a draw in the first quarter of not quite, but close to 1 million barrels a day. If you look at the fourth bar, you'll see a build. That is what the IEA supply-demand model is projecting. That's a 95 million barrel swing from expectation if you're using the consensus numbers, and that is a huge problem. The other thing I will note here is if you look on the right, and even though it's very, very preliminary, we published to our clients an estimate for demand globally in March, and the chart looks kind of innocuous, except our numbers for the first quarter of this year are 1 million barrels a day higher than the consensus, which goes back to the issue of missing oil again. So the balances still look quite tight. We expect they're going to continue to tighten. How much they tighten will depend ultimately on how much Russian supply does get impacted. The question that I know is out there is, are prices even at, we're close to $100 a barrel, are they too high? Is it going to wreck the economy? No. So this is an analysis that we've been generating for a very long time. It's called an oil burden. It looks at the expenditures on oil as a percent of GDP. We tend to tell our clients to think of oil prices as really three key ranges. One that kills supply, which is tied to cash operating costs. One that OPEC is trying to target, which in many cases will center around the Saudi budget or our analysis of the Saudi budget. And then there's a price that you think of that kills demand, where expenditures on oil get to be problematic. That is a very specific range that you see there on the right. It starts at around $130 a barrel, actually starts at $130 a barrel for Brent, goes up to $181. $130 a barrel for Brent for a year. This is not the price in just one day. It's an annual average. Pushes your expenditures as a percent of income to about 5%. Now, 5%, you start tapping the brakes, but in terms of jamming on the brakes, you need a price close to $180 a barrel. So we are not anywhere close to a point where we're thinking, oh, prices are high, it's going to really kill demand. We're more worried about a sixth wave of COVID or something happens with the war in Europe that has a much bigger spill-out effect. But the price of oil itself here is not at a point where we're concerned or even expressing any concern. And then the last graphic I have here before we kind of get to the Q&A is essentially energy equities trade as a proxy for the commodity. Now, if you look on the right, we made a call back in October 20 that energy stocks at that point had become unfairly low. They were priced too low. They were out of line with oil prices. And we made a well-timed call, I suppose, in hindsight, that you need to accumulate those stocks. If you look at the Canadian index, it's up 260% since that time. Energy has basically been leading the broad indices in every main market center we examine. If you look at the left, you'll notice there's a gray oval there. As much as the energy equities have moved, they are actually still too low based on current oil prices. Not where oil prices are going, just based on current oil prices. And Canadian energy names trade off of the 2-year forward WTI price, just like U.S. equities trade off the 2-year forward WTI price. So if you're thinking, oh, I missed it, not really. There's still a significant amount of opportunity here, and we think that we are in a multi-year upcycle. So before I show the necessary disclaimers, the legal mumbo jumbo, if you have questions, if you're interested in our research, you can email Oliver. The address is Oliver at Cornerstone Analytics. More than happy to see what we can develop. And then, of course, this is the legal mumbo jumbo. So at that point, I will just stop my screen share. And I think we should be all good, and you can see me and hear me normally.
We're back. Thanks, Mike. Awesome presentation, as always. I think a lot of the data and the graphs you would have presented to people is out of the realm of consensus. So I want to dig into some of the major themes. We've got about 10 minutes. And so we may repeat some of the major themes, but repetition is the mother of skill here. So noise versus what matters. I want to talk about the SPR release. What does it truly mean for the short-term picture? My belief was we needed to reach a price level this summertime to kill discretionary demand because of the imbalance. In your mind, did the SPR, one, is that where we were headed? And if so, did the SPR push that inevitability out? And if so, when do you think that magical point is?
There's a couple issues. The SPR release is kind of like throwing deck chairs off the Titanic, because you're trying to take what should be a short-term measure to solve structural issues. So you're kicking the can down the road, but you're not solving the problem. I guess another way of saying it is like taking aspirin for a brain tumor. You know, the headache may go away, but you still have, the rot. So in our estimation, this is led by the U.S. because the White House is trying to get gasoline prices at the pump down ahead of midterm elections. There's a very strong inverse correlation between gasoline prices at the pump and the president's approval rating. So, you can do that math yourself. However, the thing is, the oil balance was going to tighten this year as things stood. Now, our view about that happening was not the consensus view. The consensus view was that inventories were going to swell last year. They didn't. We had a record draw. And then it got pushed into 2022. Well, they're going to swell this year. We're going to get stock builds, which obviously we're moving in the opposite direction again. So the SPR really doesn't solve the problem. We don't think it's going to solve the problem. And if the losses of Russia and Kazakhstan or anything else for that matter are anywhere close to that 3 million barrel a day level, it's going to be like throwing, ping pong ball at a charging elephant. You're just going to end up as sort of mushy stuff between the toes.
Mike's the king of analogies. Okay, so let's say it's inevitable. Demand or supply cannot grow to meet demand growth going forward. There's structural challenges. Oil has to go high enough to rationalize discretionary demand. What is that price level, and how long do we have to hang out there for?
So the number is 7% of GDP, and based on the estimates of notional GDP for the current year, that gives you a Brent price average, again, not for one day, average annual of 181. Now, that's 7%. That really is like the proverbial shot in the back of the head. Kind of starting to put the brakes on is when you get to an average annual price of about 130. That's where we start to tap the brakes. But there's another $50 on top of that to really do what I consider the demand rationing that's going to have to happen at some point.
What excites me with that is we think energy stocks are discounting an oil price of about $60. In fact, lower now because we're down 3-4% today. So, investors clearly are not discounting even $100 where we were trading as of a week ago. When we think about Russia, a lot of the discussion now is what's the short-term impact? Are we, Russian exports haven't been changed that much from guys that track ships. You would think that's going to be more impactful in May. But I don't want to focus on the very short term. What do you think the medium to longer term consequences are when, the civilized world have finally made the connections that buying oil from Russia weaponizes energy and allows them to buy 48 cruise missiles a day, with which they can kill innocent kids? Like, what's the medium to long term impact when service companies have walked, the global super majors have walked? Because I haven't seen much discussion on that. And to me, that's the much more important conversation to have.
So the question is, if you don't want Russian oil, what's your alternative? And the answer is freeze, turn off the lights, and don't eat, right? That's your alternatives. Go back to the Stone Age. There is no way to make up for a Russian supply. None. So the question is, how does one then think about pushing Russian oil out? And the answer is, well, you got to grow production capacity. Well, you've taken out over $2 trillion in spending, and you have a literal army of people that are virtue signaling, lobbying on anti-carbon, which will only end up intensifying the bullish pressure on oil. And then you have a dialogue going on of green energy. Now, I got 5 grandkids. I got number 6 on the way. If someone invents fusion in a jar, that's awesome, okay? But in what I call the forecastable future, there is nothing of scale that looks like it can displace oil. And when you think about hydrocarbons, when you take that discussion and broaden the focusing ring and think about hydrocarbons, the largest commodity consumed in most defined economies is electricity. More than oil, more than food, water, textiles, it's electricity. And about 55% of the world's electricity comes from coal. And another 20-something% of world's electricity comes from natural gas. So when you start thinking about getting rid of hydrocarbons, again, if you want to go back to the Stone Age, that's awesome. That's not how I want to live. But short of that, the reality is there really isn't anything of scale that's going to be able to, A, make up for Russia, B, try to get rid of oil or energy in the mix that's hydrocarbon based. I mean, you have this philosophical divide about someone saying oil's bad, and guys like me who do supply and demand work just sort of look in disbelief that because you think it's bad and you need to prove that you're a good person by saying oil is bad, you have no concept of the reality of the way the world works. The world runs on oil. That's kind of the bottom line. About 74% of the world's oil is used for transportation fuels. About 24% of the world's oil is used to make plastics. Like even a Tesla, I got nothing against Musk and what he's doing, but even a Tesla takes about 60 barrels of oil to make the plastic that goes into that car, right? The world simply can't get away from oil. Maybe in 30, 40, 50 years, somebody really does figure out a way to burn, seawater and sunshine. But the problem I see is that we are kind of locked in its use. Oil demand is perfectly inelastic for a reason. So the bull cycle is not a short-term thing. It is a multi-year cycle we're talking about.
And I've told clients my view is, we're in at least a 5 to 6 year bull market because you effectively need the most woke companies to pivot and start investing again, which we're not even remotely close to that time point. So on days like today, Monday morning, oil's down $4, Shanghai's locking down, et cetera. You've done some of the work you've done, I love, and that is the physical demand for oil versus the financial demand for oil. Can you, in a short time manner, discuss why that's important on days like today? Because I find it gives me a lot of comfort to be able to have staying power on down days.
So we've had situations where oil sells off dramatically. And I remember getting a call from over $1 trillion firm, the number 2 person, saying, is oil demand collapsing? Because we're being told the price of oil is selling off because oil demand's collapsing. And it's like, no, oil demand is actually coming in at or above forecast. What's collapsing is the financial demand for oil. And you say, well, what the hell does that mean? So if you take a commodities class in college or graduate school, you're told that the paper market for a commodity matures at 3 to 5 times the size of that commodity's demand. So if the world uses 10 million pounds of sugar a day, a mature commodity futures market is going to trade 30 to 50 million pounds a day, right? 3 to 5 times. The 6 main contracts that trade energy right now are trading 32 times the size of world demand. Then you have options on futures. That's another 8. It's 800 million a day roughly. And then you have an unregulated over-the-counter market. That's another billion to 1.3 billion barrels a day. So you're talking about a multiple that's 50 times the size of the paper market. And that creates situations where the proverbial tail wags the dog. So the market can move on a headline, usually because of these different factor models and AI models people are trying to build. I call them soulless trading models. But you can get the market to move on something that seems innocuous because it generates enough angst that people just start to, literally liquidate. And that is what today is about. If you look at all the headlines last year about COVID, different variants, et cetera, it's going to make your head square, whatever. We had plenty of days like this. Meanwhile, the price of oil, went from, 40s to, we got to 130 in the wake of Russia. But even at today, you went from, 40s to 100. And, a year ago, most people thought that the price of oil being over 60 was impossible. I have all the emails to prove it, right? It's no way oil is going to be able to stay over 60. But paper market being big creates this kind of, these kinds of moves that just don't line up with underlying fundamental pressures.
All right, we've got 4 minutes left. So if you can keep the answers punchy on this. U.S. shale. Are the best days behind us? What growth rate do you expect this year? And how many more years of growth are left in U.S. shale?
Yes. I think I'm 700,000 this year. And then I think we kind of peak out in 2 to 3 years. I'm not being glib by answering like that, but the problem with shale is the shale oil well has a life of only about 5 years. That's the problem with shale. You take a piece of crap oil field like Maracaibo in Venezuela, mismanaged and all, still producing from when it was discovered in the 60s. Shale, you got to keep blowing your proverbial brains out to try to replace existing production. So I do think the best days of shale are behind us. I do expect we'll get some growth this year. People thought it was going to grow 1 million a day last year. And U.S. production was down year over year. So there's still a lot of people out there that kind of think we're going to get this big life preserver effect from it, but I'm not one of those guys.
All right, OPEC spare capacity exhaustion. Do we hit that this year? And if so, what does it mean for the oil price?
I do think we hit it in the fourth quarter. My supply-demand model has OPEC maxed out in 4Q, and we still get an inventory draw. Now, the thing is, we don't have a premium in the price of oil, not a war premium, not a risk premium, no security of supply premium. And what I guess I would be afraid happens later in the year is the market gets tighter, all the SPR sales, don't work, and then the panic sets in. And all of a sudden you go from people thinking oil has to go back to 60 to, oh my God, it's going to 260. If we run our numbers based on what inventories are going to do, we come up with an oil price. That's something you're familiar with. You've seen it. I use my model called Miker. But if we get to the point where capacity, if we're right, which is heroic and stupid to say out loud, but let's just say we're right, you can get a nonlinear response in oil prices, and that's the panic.
All right, we've got time for two more questions. One is, how does this end? You've got demand growth, I think, for at least the next 10 years, exhaust spare capacity within OPEC, global supreme majors, there's no growth to the end of the decade. US shale, we've got a couple years of meaningful growth left. Like, where does this take the oil price? Not this year, but when we're thinking of about a 4 to 5 year plus environment, where do you think oil comfortably trades at?
It's a good question. I don't know exactly how to answer it because I never just do point in time numbers. I would tell you it's going to be higher lows and higher highs. That's going to be the general trend because it's very uncomfortable for people to think about the idea of demand having to regulate the cycle, right? Cure for a high price is a high price, et cetera. You think, well, there's going to be a demand response. There's going to be a supply response. In this particular case, price of oil is at a level that should encourage production growth. We don't think that's going to happen. I think non-OPEC supply growth is going to be much more problematic than people realize and disappointing. OPEC, in terms of their spare capacity, is going to be challenged, which means you're left with the idea of demand regulating the cycle. And that analysis about a price that's too high based on expenditures as a percent of GDP, that becomes very central to the outlook. So I think we're going to be getting, a channel, but it's going to be a channel, up into the, I guess if you're looking at a graph, up and to the right, meaning higher lows, higher highs. And we're just going to have to go between these cycles of regulating demand, getting slack in the system, and then the system gets tight again.
So last question. This is a question I get from clients all the time. And you've done a remarkable job of calling the oil price. We've done a pretty good job of adding value for our clients. But what I get asked is, okay, that's great, but where could you be wrong? Where are you screwing up? What are you not evaluating? And so as two guys that are bullish on oil, where could we be wrong? What are we just not thinking of?
Okay. And that is a question we get and we anticipate it. And I think it's perfectly fair to ask. So my big concerns, or we get something that really derails demand, meaning we get a sixth wave of the pandemic. We get the war between Russia and Ukraine becomes somehow global and disrupts the global economic system. Those kinds of things are what I worry about. And I don't get paid to forecast global conflict, but that would be an area that would have me concerned. Even when I get asked about recessions, I'm not particularly worried about a recession. Even if you look at what happened in 2008, 2009, price of oil bottomed between 40 and 50 in the worst economic climate in 80 years because OPEC managed supply correctly through the demand downturn. But where I really get worried is something that to me would just derail demand. I'm not really worried about something like fusion in a jar. I'm not worried about technologies. You hear about electric vehicles. I think that's kind of a big scam, but that's a different discussion. But that would be my answer.
Good. All right, we're up against the time. We wanted this to be punchy, be respectful of everyone's schedule. So on behalf of myself and Ninepoint, Mike, thank you so much for agreeing. Mike's work has been tremendously valuable. We have an army of guys whose research we get, but Mike has consistently called the oil market better than anyone else that I can think of, quite frankly, in recent years. It's differentiated. It's presented in a manner that I really like. So thank you very much. And we're excited. We get days like today. There are wobbles in the market. There's noise, and then there's what matters. And Mike was the one that taught me focus on inventories. Inventories are the nexus of supply and demand. We remain extremely bullish on the outlook for oil and energy stocks. And with stocks discounting in our mind, in our fund, below $60 per barrel, we think we'll see $100 in the not too distant future. Most firms are calling for well in excess of 100 by the summertime. We remain very, very bullish. So thank you very much for joining. We look forward to doing more of these in the future.